Welcome to The Explainer. Today, we're tackling a topic that literally keeps UAE business owners up at night: value-added tax, or VAT. We're going to use this as our ultimate step-by-step chronological guide to navigating the Federal Tax Authority's VAT system. We're going to figure out how to do the tax math correctly, understand exactly when you're legally required to register, and most importantly, how to keep your business fully compliant.
Okay, let's dive straight into this. 10,000 dirhams. That is the immediate, absolutely non-negotiable financial penalty the FTA slaps on your business for missing that mandatory 30-day VAT registration window. It is an incredibly expensive calendar mistake to make, and honestly, it gets worse. You also get hit with retroactive VAT liability on every taxable supply you've made since crossing that threshold. And you can't exactly go back and pass that cost onto your customers after the fact, right? It just eats directly into your bottom line. So, let's make sure you never have to pay it.
Just to respect your time, let's look at our roadmap. First up, understanding UAE VAT thresholds. Second, we'll decode zero-rated versus exempt supplies. Third, calculating your VAT turnover. Fourth, that step-by-step Amar tax portal registration. And finally, common mistakes and penalties.
Let's start right off with Section 1, Understanding UAE VAT Thresholds, Navigating Mandatory and Voluntary Limits.
Before you even think about touching the registration portal, you've basically got two distinct lines in the sand. The mandatory threshold is $375,000. If your taxable supplies and imports blow past this, or if you expect them to in the next 30 days, you absolutely must register. But there's also a voluntary threshold at $187,500. Now, you might be wondering, why on earth would anyone volunteer to pay taxes? Well, it's actually a massive strategic advantage for startups. If you've got high initial setup costs, office fit-outs, heavy equipment, professional fees, registering voluntarily lets you recover that 5% input VAT you're paying on all those early business expenses.
But, and this is a huge but, here is the trap that catches so many businesses off guard. That 375,000 dirham threshold, it's based on a rolling 12-month period, not your calendar year and not your financial year. If you only bother checking your accounting at the end of December, but you actually crossed that threshold way back in August, guess what? You've already missed your 30-day window and you are already on the hook for that 10,000 dirham penalty. You have to track this continuously.
Which naturally brings us to Section 2. Zero-rated versus exempt supplies, the classic classification trap.
Now, what's really interesting about this slide is how tricky things get right here. We've got two categories that sound virtually identical. I mean, they both charge 0% VAT to the customer, right? But underneath, they operate completely differently. Zero-rated supplies are technically still taxable. That means they definitely count toward your registration threshold, and critically, they let you recover input tax on your expenses. Exempt supplies, on the other hand, are completely outside the VAT system altogether. They do not count toward your threshold math, and they completely block you from claiming any input VAT on related expenses.
Let's make this super concrete with some official FTA examples. Say you're exporting goods outside the GCC, or providing preventative health care or running a recognized school. Those supplies are zero-rated. But if you're renting out residential apartments, selling undeveloped bare land, or offering financial services where there's no explicit fee, like interest on a loan, those are exempt. You literally cannot afford to mix these up when you're doing your calculations.
Moving right along to Section 3, Calculating your VAT turnover. Let's do some real-world math.
All right, let's look at a quick scenario. We'll call them Rose General Stores. They've got a pretty standard mix of revenue streams. We include the $375,000 from standard taxable sales, obviously. We also include the $125,000 in exports because, as we just learned, zero-rated supplies definitely count. We add the $100,000 in imports and $25,000 from reverse charge supplies. But see that $50,000 of exempt supplies? We are explicitly kicking that out of our calculation. It doesn't count.
So, when we tally up all the included streams, we hit AED 625,000. Because we properly excluded those exempt supplies, this math is airtight. And since 625,000 is well past that mandatory 375,000 mark, Rose General Stores is firmly required by law to register for VAT within 30 days. No way around it.
And this brilliantly illustrates exactly why we need Section 4, Amara Tax Registration Step by Step, Navigating the Portal.
The FTA has actually streamlined this into a pretty straightforward 5-step linear process on the Amara tax portal. First, log in and create your account using your UAE Pass. Second, you set up your taxable person profile for your specific legal entity. Third, initiate the actual VAT registration application. Fourth, plug in your financial data and upload all those supporting documents. And finally, wait for the FTA to approve it and issue your 15-digit tax registration number or TRN. Just a quick, absolutely crucial side note here. You cannot, under any circumstances, charge your customers VAT until you actually have that TRN in your hand. Doing so early is a major violation.
Now, to make Step 4 completely painless, just gather these exact documents in PDF or DOC format ahead of time. Keep in mind, the portal limits files to 15 megabytes a pop. You're going to need your corporate docs, like your valid trade license and your MOA, plus the Emirates ID and passports for the owners, and a bank account validation letter in the company's actual name. And here's the big one. To prove you've actually hit the threshold, you need at least 5 recent invoices if you're doing mandatory registration, or signed contracts and POs if you're going the voluntary route based on expected turnover.
All right, into the final stretch. Section 5. Common mistakes and penalties. Think of this as your survival guide to staying compliant.
Look, the FTA is running tens of thousands of these digital audits, and the exact same mistakes keep triggering penalties. We already covered late registration and the whole exempt versus zero-rated mess, but another huge trap is claiming input VAT on client entertainment. Meals and hospitality for external clients, strictly blocked from VAT recovery, for sure. Also, ignoring the reverse charge on imported services, like paying for software subscriptions from abroad, that's a massive red flag. But honestly, the most frustrating one is just not filing nil returns. Even if your business goes dormant and you literally have 0 sales for a quarter, you still have to log in and file a mandatory nil return. If you don't, boom, immediate 1,000 dirham fine.
So the crucial point here is how the FTA actually penalizes you for late payments. Currently, it's this brutal compounding system. 2% right out of the gate, another 4% after a week, and then 1% every single day, capping out at 300% of the unpaid tax. Ouch. However, there's a major shift coming up in April 2026 under Cabinet Decision 129. The FTA is swapping that out for a flat 14% per annum rate, calculated monthly. Now, while that new model is definitely way more predictable for businesses, make no mistake, it is still a heavy cost that will completely drain your cash flow if you're not paying your VAT on time.
Which really leaves us with just one final, burning question to wrap up our explainer today. Is your rolling 12-month turnover creeping up on that $375,000 threshold? Or if you're a startup, are your expenses approaching that $187,500 voluntary mark? Look, don't just wait around for your accountant to tell you at the end of the year. Go check your books today, map out your next 30 days, and make absolutely sure you stay safely ahead of those FTA deadlines. Thanks for joining me on this explainer, and happy calculating.